Welcome, everyone. The goal of this series is to have a conversation with your favorite traders, investors, as well as DeFi analysts. Join me in learning about their journey, talk about trading, investing, and everything related to crypto. Today, I have the privilege of having with me Kuhn, 0x_Kuhn on Twitter. I actually happened to come across his tweets about a few months ago when Crypto Lynn mentioned us together in a list. Once I started reading his tweets, I was 100% on board. He lays things out in a thought-provoking yet succinct manner and has a very stoic approach to investing. So how can I not like the guy? Without further ado, thank you, Kuhn, for taking the time to join me for this conversation. How's it going?
Mate, I'm doing well. It's a pleasure, and yeah, I'm happy to be here. So thanks for the invite.
Of course, it's a privilege to have you on. I was really looking towards this conversation. Let's jump right into it. So first of all, what's the story behind your account name on Twitter? And by the way, is it Kuhn? Am I saying, is it the Japanese Kuhn?
Good.
Is that
Yeah,
what
good.
it
Yeah,
is?
yeah. Yeah,
What's
so
it?
the
What's the story
so
behind it?
yeah, so the story behind it, no one's actually asked me, and it's kind of pretty simple. But crypto, as you know, has a Japanese subculture which started with Satoshi. And so the Japanese could means like referring to someone of junior status. So I intended it to mean, like always be a student, always learn. And The OX is homage to kind of when I joined CT. So like for my first cycle in a bit, I didn't even know there was such a thing as CT. But when I did join, I saw like the previous gen had XBT and then the new guys all had OX, obviously referring to the ETH addresses. And it was suitable as that's where I kind of started playing with alts. And no one's asked me about why the location status on my account is Ryukyu Islands, but that's where they say the surname Nakamoto is most prominent. So it's a homage to Satoshi, the kind of cultural background setting that's created within the wider crypto ecosystem, and then to when I started. So that's what it is.
That's awesome. And, I had to ask because someone who provides such thought provoking takes, I always have a feeling that there has to be some thought behind why they chose a certain name, account name, or location and those kind of things. So that's really interesting. Thank you for sharing that. And you were talking about your first cycle. So just let's jump right into that as well. How did you get involved in investing in crypto? And what was your background before crypto?
Yeah, sure. So I say I learned to invest in crypto by like just a coincidence of chain of events. So I don't know if it was because of like, those suit hedge fund movies or interest in business or money, but, just was always interested in investing. And when I was 18, I'd look at like the finance section of the newspaper and see, all the tickers, kind of like crypto, like it'd be like three tickers with, whether the price was up or down for the day. And then based on that, from what I'd saved, I'd literally just buy stocks based on if I liked the sound of the name and got some voodoo impulse on price being up or down. And obviously, needless to say, that wasn't too successful. But it was really useful just learning about the emotions of fear and greed, and being able to learn that with smaller money, relatively speaking, which helps you when you manage bigger money later. And so after that, it got me reading into more about investing and value investing and Buffett and intelligent investor, yada yada. And when I looked out and did research, I found a lot of things like after that time period was where I thought there was kind of value in the market was kind of in banks, in oil, in gold miners, things that were kind of out of favor post the years of the financial crisis and also cyclical in nature, and bought those. But after I bought, I was reading from economists and forecasters of like reputable, big firms saying how it was a bad time for banks, and you shouldn't be buying oil or gold because of this and that. But I just left it because I'd already bought, and it was a lot in fees at the time. I think like it was like $40-50 transaction fees every time you bought and sold, and then you have to worry about tax and this and that. So I didn't listen to any of that kind of advice. Just left it in, and then sure enough, after forgetting about it for a while, they went up, and it wasn't a huge gain, but enough to make me remember that like economists and analysts are just like well-dressed guesses. So yeah, that was like an imprint in my mind, which obviously helped forward moving into crypto. But And then after uni, I started working in startups in the business dev side when it wasn't cool to work in tech sales, maybe still not cool. And I got to see how SaaS companies were run, and I could see that valuations didn't make sense in a way that was relevant to value investing, but they were still growing and obviously considered very valuable. So learn a bunch of important stuff like network effects, about growth rates, impacts on valuation, but more importantly than the financial elements, which has been very helpful, is I learned about solution selling. So, and by solution selling, I mean we're trying to sell based on where people are trying to sell based on, oh, you have more features and better tech doesn't really work. Customers just want a solution to their problem, and that's not always what has more features or better tech. And obviously, just as a side point, that's what helped me a lot avoid the nonsense in the first those bull runs where people are talking about this is better tech, and because I've seen how software companies with no users, kind of like in the 2000 tech bubble, that it might go up, but they end up at zero. So it helped me avoid going to zero. Obviously, unfortunately, other people may have learned that going through the hard way, but that was certainly useful. And then so then I was investing my income into tech growth stocks as I understood that kind of SaaS landscape. And that's where I first saw the crazy earnings, multiple expansions, crazy future earnings forecasts based on recent trend. And then generally, like hype and buzzwords like the mobile wave, SaaS eating the world, partnership announcements that didn't really change anything internally that I could see. And so that kind of naturally led into the crypto, because while I'd seen something online about Bitcoin like years before, I'd forgotten about it until a brother's mate talked about Bitcoin. And I did a bit of research to learn about it. Saw it had already gone through ups and downs, kind of like that kind of cyclical bear up and down nature. And this was towards end of 2015. And then after reading about it being unpopular at the time, I didn't know if it would work, but obviously it resonated to me on multiple levels from my previous learnings. Like software, all apps were previously things, whether it was cameras or calculators, the physical world moving into digital. And it really got me this sense of like the financial world and kind of the crappiness of airports are the only things that hadn't been really digitized or moved digitally. So that kind of resonated with me, that it kind of seemed like something that would happen. And then remembering about gold and store of value and how buying anti-cyclically in bear markets had worked for me, obviously out of luck. And then the nature of early tech growth and the concept of, crossing the chasm, where I'd read about like, how many assets would grow to be over, 100 billion or potentially a trillion, and then once cross, kind of they don't end up becoming a bubble, and like that kind of thought process interested me. And then obviously I didn't know how big it was going to get, but that's kind of how I first got interested. And then that's how I started.
Yeah, that's awesome. And I had a similar kind of journey in the other direction where I got exposed to Bitcoin fairly early on. I read about Silk Roads, and I think at the time I had a minimum wage job. I was fairly young. The Bitcoin was like $200-300, and I did the opposite where I didn't forget. Right, if I had just forgotten about it, and I think for most people, we'll get into this as well. For most people, it's a lot better to just forget about it, right? And
Yeah.
so for me, I ended up selling it for shekels, compared to eventually what the value ended up being.
Mm.
But in terms of your journey, what I really want to get into is what is your strategy now, your philosophy around investing, and how has that evolved over time? What kind of hurdles did you go through in that journey of learning, and what your philosophy looks like now?
Sure. So as I mentioned, kind of like even in that first part, like a lot of the lessons that you would kind of learn if you'd started crypto from scratch, I kind of learned periphery vicariously via investing and learning about other assets, which kind of gave me a multiple year, I would say, advantage in terms of coming to some of those lessons that you come to in crypto in other places. But kind of in summary, what that kind of taught me was that when you first start in markets, you do just kind of look for picks, how much can it go up? And then once you lose money, you start thinking about, oh shit, how much can it go down? And then you learn about portfolio structure, so that okay, I need to make sure that I don't go to zero. So how do I create a focused portfolio, but one that is not structured around zero or hero, which is what a lot of people do. And then the sizing and percentages, like what actually makes sense within that, and what is your process to find and build a portfolio. And then the most important thing, though, which in the end you realize, is that behind it all, it's really the right temperament and psychology. And investing well is really an inside to outside process, whereas most think it's an outside to inside. And so, yeah, that's kind of, in summary, in short, like what my journey has made me realize in that process.
Yeah, there's some great points that you mentioned here, and a couple of things I want to kind of dig into a little bit more is a comparison between traditional markets and crypto. Now, there's a lot of people that try to apply fundamentals when it comes to crypto, and this space is fairly young. So, using fundamentals, I'm not an expert investor, right? I haven't managed someone else's portfolio. I haven't done any of that. So, I'd like to get your take on this as well. And one other thing I want to delve into is so I have gotten around to this book way too late, but The Alchemy of Finance. And I was reading how Soros spent maybe 15 to 20 minutes looking into, something he's interested in. And then he'd dig in deeper eventually. So he'd applied a combination of system one and system two thinking. What's your take on that? If it takes too long to understand an idea, is it just not worth pursuing any further?
I would have to say that, and we can talk about kind of like the overall process and stuff. But if you can't understand it, then you can't really invest in it. And it's not because it can't go up or it can't go down, but that's why I tell people you need to have a thesis and process, because in crypto, what people do is they say, well, you know, the fundamentals don't matter because it's just going to go up. But if you don't have any kind of framework in which you are able to evaluate whether something is considered early or low, or what the price is, I mean, it could still be crazy speculative overvaluation on a 50% drop. You don't know. So then if it drops, you're going to sell because, oh, this is hyped. But if it goes up, you don't know if you should sell because you think it can go higher. And so just from that view about understanding, I think, that's, I mean, from a crypto lens, you want to be able to understand it enough where you can at least understand the meta.
Yeah, no, 100%. That makes sense. And the other thing I wanted to dig into as well is fundamentals. Like, what's your take on that when people are applying fundamentals to crypto to evaluate a protocol or a project?
Yeah, so I did a thread on this about how applying traditional investing frameworks to crypto, it doesn't quite fit, but people can't quite put a finger on it. So if you want me to go over kind of a few of those points, I'm happy to do that. So like, for example, and this kind of relates to my story as well, but like, traditional value investing relies on fundamental analysis to pick stocks that appear trading for less than their intrinsic or book value, right? But crypto is really in the early adoption cycles. And so current fundamental analysis, it's not the most important thing because you need to consider future usage and then valuations, right? In growth tech investing, you kind of see the past performance and revenue growth rates, and then you kind of project out the future to calculate what the current net present value is and how it might become profitable in the future. But crypto is in that kind of early innovation phase, so you can't project kind of historical growth into the future as you kind of could for established kind of tech startups and growth over many years. But then you've also got like TradFi Venture, which is a bit more closer in nature, where you kind of invest in the infrastructure and then until it reaches some kind of sufficient size and credibility so that it can be sold in public markets. But crypto goes public much earlier than finding product market fit. So the RR is not kind of as binary or liquid as you make an investment and then you hope that in 7 years it works. Like you can literally sell 2 weeks after an idea is formed if there's a token. And then even with the thing that works the most kind of for like trading folk is that, the nature of the way that you would do charts is the same, but it's more volatile on lower liquidity. So the time horizons, leverage requirements, kind of the nature of the trades that you kind of take, it requires like updated mental models. So in crypto, the focus is more on like future adoption, where that kind of historical growth can't always be applied. It's liquid from traditionally venture stages, and you're betting on both like the tech as well as the protocol. And they could both completely flop, but you can still make money off other people's emotions of greed and fear. So those kind of usual course skill sets in traditional investing, like deep FA, deep TA, being able to mathematically project future returns, or whether you're a venture where you're helping teams scale or you have long time horizons, like all those things are still important. But the unique thing in crypto is the ability to deal well with volatility, play off others' greed and fear, and a real focus on managing risk reward in a way that's more akin to being a poker player than it is to kind of traditional markets. So yeah.
Yeah, no, you dropped some gems there, and I was actually coming to that, and I didn't remember if it was you or someone else who tweeted this about poker players doing well in crypto, but I think you had a phenomenal thread on that as well.
Yeah, I did tweet. I've tweeted multiple times on that because it's kind of like, look, you can, obviously no analogy is perfect, and obviously it's just a thought exercise, but it's really like a poker player doesn't know the outcome of the flop or their hand. They look at their cards, and a good poker player already mathematically knows the percentage chance that they're going to win. But then on top of that, you're playing off other people's emotions, because you can bluff, you can, there's that fear and greed element. So they're able to consider their position amongst fear and greed. And then they recognize that you have to have risk management. You can't just go all in just, on a whim. And so they manage their bankroll, and then if you play the percentages right over time, you're going to win. But you just don't know if it's the hand that you're playing or if it's going to be the next hand. And so that kind of mindset is really well aligned to crypto.
100%. And I'd urge anyone listening in to check out Goon's Twitter, because he drops gems when it comes to this information. And he goes at length to explain, why poker players and why that mentality does well when it comes to crypto. So I want to pivot here slightly and talk about, risk management and loss. What does risk management look like for you? And have you ever dealt with significant loss, a series of losses? And How did you go about dealing with that? And if there's any tips for anyone listening in?
Yeah, sure. So I think the most important thing about investing that it doesn't matter if you're in traditional markets or crypto. It's something that I've seen that's common amongst the best is that risk management starts with that you might be wrong, right? So you have to consider that within a portfolio structure, within the sizing, within your process for positions, and having both a thesis and invalidation thesis. And you need to position and view the world in a way that obviously you think you're right, but then you have to make sure that if that view doesn't play out, that the outcome is not that you are wiped out and you're out of the game. And so that's kind of the balance. And I say kind of as a, as an extreme kind of thing so that people can get an idea for it. You have to be in a situation where on the left side, if it screws up, you don't want to jump off a cliff. But then on the right side, if your view plays out and then you didn't position correctly because you were too conservative and you didn't find that balance, that you don't want to hang yourself. So there's a struggle in both directions. And that's why that emotional control and understanding yourself, being self-aware is so important. And then to your question about have I dealt with any losses? I mean, no one's been in markets who's worth their salt and hasn't dealt with a big loss. The biggest indicator of someone who's going to lose a lot of money is someone who's only seen the up. And so, yeah, luckily I've never had a world-ending loss to learn that lesson directly, but definitely rugged, you name it. And so what I learned though from that is like you really have to be pessimistic and optimistic at the same time. And this is where the sizing and portfolio is so important. So like just as an example, if your portfolio was split like 70% was BTC ETH, where 70-30 was split, BTC ETH, and then say 5% positions in alts, you're mentally thinking, okay, well, on my worst case, if there was a 2x on BTC, even if ETH and every alt you bought went to zero, you're still break even, right? And then you think, okay, well, ETH has a higher beta. So if, this is hypothetically speaking, obviously, because, we're not going to realistically imagine like ETH doing 3x when BTC goes to zero. But just for the sake of this, point is that if ETH did 3x and all the other positions went to zero, then you still break even. And then similarly, if BTC doesn't move, ETH doesn't move, but like one alt does 20x, that's a 5% position, it covers your whole port. So you have to figure out the maths. And so if I saw someone's portfolio and percentages, but I didn't see the actual picks, I could still tell you where the risk is, not by the picks, but just purely on the maths. There's just maths that you can't avoid. And it's something that in crypto, instead, people have this inverse pyramid structure in their positions where it's like my highest confidence pick is, 50%. And then the next confident pick is 40%, and then 30, 10, 11, and then 1%. But it completely goes against, like, that's not diversified. But then it's also too focused, because if your 1% position does 30x, it hardly makes any dent in your port. And so you're really relying on your top one position to do well. And if that top alt position fails, then no amount of X's on a 1% position is going to be able to cover and take care of that loss. And so, yeah, you really have to do that. So the tip is firstly, like no one can avoid that learning curve. And so if you have taken a big loss, think of it as paying for an MBA, like a master's in making money, and then just realize that how much you can lose and to an extent how much you can make is already decided before you start, because of your psychology. So and the maths behind it. So what do I mean? So I mean, like, the sizing of positions, um, like how much you can lose is already decided up front, right? Because it's how much money you put in, it's how much you put into each position. So, a loss in any position, should be painful but not deadly, but a win on any position should be meaningful to your portfolio. So like if a 10x isn't portfolio changingly good on any given position, I think it's too small. And so, yeah, if you're starting with small money, just think of it as like, by the way, just kind of as a side, but kind of relevant, is people say, oh, if you just have small money, you should just focus on making, an income, increase your job income. And that's definitely true. Like that should be your main focus. But kind of like my experience, like I told you about playing with that money, being stupid with tickers and stuff when I was at uni. Similarly, I still think even with small money, think of it as a learning curve, and learn these lessons in the market with what you can afford to lose, and so that you can build from there. And so, yeah, that's what I'd have to say about that.
Yeah, you've covered. I mean, there's so many different things we can talk about for a long time, probably. But you covered a lot of amazing things there. I mean, having a probabilistic mindset. Um, you talked about being optimistic and pessimistic at the same time. Like, where's your invalidation? And one of the bigger accounts that we've been obviously talking about quite a few this past year or so is Capo, right? And there's a lot of these bigger accounts that are the kind of enshrouded themselves with certain ideas without providing any invalidations. So understanding what can go wrong rather than just focusing on 100x's, 1000x's, and what can go right in P&Ls and screenshotting them and all that kind of stuff. At the end of the day, if you don't have any chips to left to use, I mean, you're out of the game. So I guess that's what risk management gets you is having those chips to still be at the table.
Yeah, I totally agree with that. And the biggest problem with these, these big accounts or whatever is, like, obviously when you're right, you're right. Like you'll get on super hot streaks because you're all in on a trend. Like risk management and good process isn't about catching a hot streak in roulette, right? That's not what investing is. People say, "Oh, I'm investing and I'm running hot." Like you're using gambling terminology for investing. The um, the main thing is that those people, like on a roulette table on a hot streak, is they are ready to win a lot of money on a future that's basically one version of reality of 20. But like wisdom, and obviously we both believe, think stoicism is relevant, but and I've said this before, but wisdom is really being able to see the long-term consequences of short-term decisions. And if you were to apply that kind of street type mentality, non-process orientated over many cycles across different asset classes, like you're going to lose at some point, right? So if you're trying to build wealth, it's not about making money. It's about compounding and growing over time, and in a methodology where you're able to keep the money. And that's why some of these big accounts, and that's why, by the way, I tell people, don't assume that just because someone has a lot of followers that they have a lot of money, because I know a lot of these guys with 100K, 200K followers, they ran it up shilling, they made 8, 9 figures, and then they've round tripped the whole thing. And so you can't, a hot streak making money and keeping it, building it is very different.
Yeah, no, 100%. Okay, so there's a lot of things that we can go into here as well. I mean, yeah, with the Twitter followers, like I personally know a lot of people that don't actively post on Twitter that are extremely wealthy.
Yeah.
So followers, a lot of people coming in and following these different accounts. I think you need to be mindful of following not really equating to success. And also, Kuhn, I think this space, the issue is with leverage and the amount of gains that were made in the last cycle, right? And there were a lot of people that were clueless and ended up making a lot of money, right? And ended up round tripping a lot of it as well. But that's why this space attracts a lot of individuals with very small portfolio sizes looking to make generational wealth.
Yeah.
So what would your advice be there? There's one other thing I want to touch on as well. That Warren Buffett quote about diversification, preserving wealth, but concentration is what builds wealth. What would your tip be for someone like that coming in with a small portfolio, and they're looking to really make it out?
Yeah, look, I would say you got to have focus. And I'm not, and like I said, by my own experience going through the traditional investing framework to tech growth, what I've learned is like, yeah, you're not going to be a value investor and then make a killing like it's just not relevant in that sense. But from the position of focus, you still want focus, but still firstly consider, is it money you can afford to lose? Or is it small money, but still money you can't afford to entirely lose? And so depending on that, if it's in the kind of, look, it is small money relatively speaking, but it's still important money to me, then firstly, you're not going to be able to ride 100x because at the first 2-3x, you'll get scared at every dip and then you'll just sell the next dip. So that's why I said the self-awareness inside out is so important, because you have to kind of figure out your emotional sensibilities, your temperament, and your psychology. But look, I'm going to avoid deep diving in that, because let's think about it from the perspective of someone who this is their first cycle, or maybe it's their second cycle, but they're not really sure what they're doing. Like, these kind of thinking it's even for me, even if someone told me this when I just started, I don't think I'd be able to fully comprehend it, because it takes that kind of mistakes and learning to figure that out. So to simple it, I would say avoid the big mistakes of like having just like 30 positions. Just know, and I think people can learn this without experiencing it, that if you buy late in a cycle and something's up a ton and you lose, you're going to lose more than you started with as well, not just round trip. And so what I fortunately got to learn without having to experience it is, by being early, even if the market went to the round trip, I'd still be up, not a ton, but you wouldn't be at a loss. So make focus bets early, through 3-4 focus bets, equal sized. Don't skew it to one, so that one outcome. So basically increase the probability that you are going to hit something. And then I'd say, maybe you don't want to put 70% or something in Bitcoin ETH, but I'd still say put maybe 20 or 30% in Bitcoin ETH, so that if ETH did a 5x or something, or Bitcoin did a 5x, that it would cover for a big chunk of the losses, assuming you completely screwed up shitcoining. Because like, if you can't run up a big amount with 70 or 80%, then why would you be able to do that with 100%? So it's that kind of like thinking that through. And then I'd say, with a small amount, there are strategies to make a lot of money in crypto that large amounts cannot do. So like at the start of the year, if you're getting an Arby airdrop, or you're getting an airdrop from, on Solana for Jupiter or Pi, like those thousands of dollars, or even can be close to, 5-figure airdrops in certain cases, like getting that kind of money gets you free casino chips to have a go. So yeah, there are many games that you can play with small money that large money can't play. So those are the kind of things that I'd focus on, so that I can mathematically compound the amount of money I have starting with while learning. Yeah, so that's what I think you should do.
Yeah, no, those are some phenomenal points you mentioned. And I think people with, like you said, if you have a smaller portfolio size, you can play some games that larger players cannot play. And I think this is the only space, or, even talking to an average person, explaining to them what an airdrop even means, and that you
Yeah.
get 5 figures worth of money sent to your wallet is, completely arcane. Yeah, I couldn't even begin to explain that to someone else. So, so this is the only space that we can even have that kind of an opportunity, which is phenomenal. And I want to pivot here a little bit. So, we talked about a lot, but what I want to learn is, what do you think are your strengths when it comes to your approach to the market?
Right. So I mean, having like a process framework where I understand my temperament, what my weaknesses are, um, what my kind of disposition towards fearful and greedy markets look like, and then putting that in like a harmonious strategy with my strengths and weaknesses. And so from a view of where I actually have an edge in the market, it's not in the ability to research or whatever. It's definitely just in the temperament. And this is where even like Buffett talks about the importance of temperament. And when you're younger or just starting, you kind of quip at it thinking, oh yeah, oh the temperament, that's kind of, it just sounds kind of, you know, too basic. But really that's what you realize, that when the whole market is moving in fear and greed, like that's where the opportunity is. So I'll give you a kind of example. Like if your highs, you really want, well, you're asking me about my strength. So like basically my highs and lows are much closer together emotionally. And so I don't get swayed um, by that. And then like I look at the market as an exchange where the fearful and the greedy come together to play. And so your job is to buy from the fearful and then sell to the greedy. But like, what does that mean in a way that's more applicable? It's like, in other words, people trying to play the game of buy all-time low and sell all-time high is the game of the greedy and fearful, and it's why they lose, right? And so instead, you have to be okay with getting a decent entry by buying those that are fearful, and then getting a decent exit where you sell that off to the greedy so that they can carry it to the top. And so if you have that kind of more abundant mindset and understanding of that market dynamics, even just that will give you enough of an edge where you can make money. Like, and that doesn't determine how much like you can make exponentially. Like that's not going to make you the top 0.1% performer. But if you look at people that have stayed in the investing game, and there's few people like that in crypto and also in traditional markets, they look back and they say, oh, my average returns were 20% a year over 30 years. But really, those gains came from 1, 2, 3 amazing wins across um, a certain period, and it came because they never took on losses that were too big. They were able to stay in the game, and then when they had an opportunity, they didn't know how big it would get, but it paid off huge, and then that basically produced thousands and thousands of percent return, and then averaged out, yeah, it's 20-30%, but on any given year, most of these guys can lose, 20% or not make 30% as well. So yeah, you have to kind of consider that.
Yeah, those you mentioned some great things there, and I think we could talk about stoicism here as well in terms of feeling the emotions and controlling how you react to them, and also in terms of timing bottoms and tops. There's a lot that can be said there in terms of fear and greed. So, do you think there's any value to studying aggregate human psychology because that never changes cycle to cycle?
Yeah, so what I'd say to that is I never studied psychology per se to try to be an investor. So it's more important that you know your own psychology, because the psychology can be different. And a kind of hack, which also by pure luck that I came across, is whether it's on CT or whether it's in traditional investors, don't go and look for the best investor with the highest returns. Look for the person that you most align with from a temperament and psychology point of view, but that you can see is much more ahead of you in that journey and financially. And then when they tweet or they talk about lessons, they will be the same psychological lessons that you are probably needing to learn. A big mistake that people make is just trying to learn from everyone equally, even though they're different. Like, if you're introverted and you're trying to learn, and you, like, say you're an introverted investor and you're trying to learn from some gung-ho extroverted junkie type person who made a lot, like, the weaknesses that they're trying to cover in their process, their strengths are so different from you that trying to learn the psychology of that person or kind of wider psychology is not going to improve your performance. So yeah, one of the lucky things for me was being able to find a few people that aligned with the way that I saw the world, but were ahead financially. And that really helped me kind of speed through learning some lessons vicariously instead of having to learn them direct myself. Because you can relate to it on a deep level that's not just kind of,
Yeah,
some
that's an
theoretical.
amazing point. And the point that I like to make from like a gym bro analogy is basically going to the gym and going up to someone with like 22-inch arms and asking them how they grew their arms, right? You need to find someone. That person is going to be genetically gifted, right? And so relating it to investing or trading is what you just mentioned. Is looking for someone who's relatable, right? It's very individualistic in nature, whether it's trading or investing. And like you said, their psychology plays into their strengths and weaknesses. And so trying to emulate something that someone else is doing with a different psychology would probably be going against the flow of the river.
Mhm. Yeah, so really you got to find people, yeah, not just unique, but like, yeah, you got to find people that, like, you'll know because you just agree with like
Right.
all their viewpoints. And I don't mean become those people that just blindly follow, but I'm talking about actual investment advice from people that have made money, that are kind of maybe older than you but have the same temperament and psychological disposition, where you can see, oh, they don't have this weakness that I have, but they have overcome that weakness. Like, those are the people that you need to follow, not just like, people are too easy to just say, oh, they just say, oh, but Soros or Drunken Miller or, Buffett, or it's like, you, I mean, yeah, there's different people, because the best process for any individual isn't the best process that exists. It's just the best process that manages their strengths and weaknesses. And then you adapt that strategy as you cut out and work on weaknesses. It's kind of like an adaptive training process for, any sportsman. There are many things in many sports that, and I've experienced this, but like where coaches will tell you that, hey, don't try that. That's, too advanced for you. You're going to get hurt, right? There's a thing that you have to learn before you learn how to do that. So don't try to go from 0 to 100.
Yeah, those are some great points. And before we pivot, because I do want to talk to you about the macro environment, when it comes to psychology, do you think there's any value in studying crowd behavior, like crowd psychology, and how it relates to the markets and looking at past cycles? Or,
Right.
I mean, we have a lot of examples in crypto, right? When it comes to fear and greed, so you could study those. I mean, we have them. We This past year we've had many. With the USDC Depeg, a lot of people came in and that was their best trade that they've made all year because they saw the fear that had settled in, and they took their bets, and that was their best trade all year. What's your thought process on that? Is there any value to studying that or looking into it a little bit more?
Yeah, by the way, I want to mention two things, one about the psychology stuff and then one about that USDC thing. But the biggest thing is like, yes, obviously, learn about crowds, but like everyone kind of intuitively kind of gets it, like, oh, crowds can be crazy. But it's more about like, what are the biases that get formed? Because then you're looking out for, okay, shit, I don't want to fall for this, same bias. And so just as like, there's too many biases, and I've done a thread on this as well. But like even just a simple one on Twitter is like, just if you start following only the people that um, you only follow them because they have the same positions as you, then Twitter has an algo like traditional media that kind of just feeds you your own bias. And so over time, it becomes a self-fulfilling loop. And then you end up becoming a ultrasound bat, or a, BTC laser eyes, or now they're calling it Soylana manlets. And then everyone you ask a question to is just telling you what you want to hear, and you don't want to hear it, you block them, right? And so you don't even realize that you're just creating and curating a completely biased feed. So I think, yeah, the crowds and stuff from a general understanding is important, but the biases is what actually gets you off guard, because you could understand crowds, but then you could still not be able to manage your bias. So not just managing your weaknesses in your process, but then you want to figure out what are the biases, and then think about those biases up front and mitigate that in your process, so that you're not having to deal with it after the fact. Because like I say, this analogy about football or soccer, whatever you call it, is risk is that type of management against bias, and risk is happens actually on the field. It doesn't happen by you, swapping 10 strikers for 10 goalies when, the ball gets taken off you, right? So you have to think about that up front, and then have that defensive view on, how do I manage against biases? How am I going to make sure that all my positions are not just one ecosystem play, because that's not really diversified. That's really the same as being all in, all those type of things. So I would say just search what are the main biases. There's probably like 10, and it's very easy to just run through them and then see if you'd be caught in any of those in your process, which is much more applicable than just kind of understanding crowds. And then secondly, I just want to quickly mention on the USDC Depeg, I don't personally believe that that was a great play, because I think you might be pointing to North Rock or something that made money on that. But I think some of these people have a fundamentally wrong view of risk reward. Like, it depegged by like 10%. So then you put in hundreds of thousands of dollars, millions of dollars of your fund's money into something that if it's wrong, you're going to go to zero. But if it's right, you make 10%. That's like the opposite of risk reward and probabilistic thinking. And so that might have worked out. But like I said, you have to think about what are the long-term consequences of short-term decisions. And over time, you're going to catch a Luna or you're going to catch an FTX, and you're going to lose everything. So you have to make sure that you consider the risk reward in terms of a probabilistic downside to upside, not just, is this, wrong? Like, you could do the research and come to the conclusion that, oh, this like to 90% certainty is going to come back. It still doesn't meet the right criteria for investing in crypto. So anyway, that's just my view on it.
One thing that I'd like to also point out is what you mentioned in terms of curating the information that you consume and how you sort of look into the biases that you may have. And then we'll jump into the macro environment discussion surrounding Ray Dalio. Is he uses this technique called triangulation, where he'll get people with contrary views and sit together in a room and have that conversation to ensure that he can kind of weigh both sides. So I think that kind of plays hand in hand with what you were talking about as well, is not having that self-reinforcing bias, especially with Twitter. The problem with Twitter and CT is like people just feed into their, it's just a constant like fueling of the same thing over and over again. I think people use, a lot of people do use CT incorrectly. I do think that.
Yeah, absolutely.
Yeah, so I just wanted to pivot here real quick and get your take on the macro environment. So Ray Dalio has this book by the name of Changing World Order, and I'm not sure if you've read it, but it kind of goes through and dissects the common thread between ascension and collapse of empires, the shift in wealth and power, and he kind of talks about the big cycle of all empires following the same trend due to aggregate human behavior. And one of the phases that's spoken about is the collapse of reserve currency of an empire. And we have this, China versus U.S. thing. Although recently China has come out with a fairly friendly posture when it comes to the U.S. But just curious to know what your thesis is on the macro environment, where we're headed globally in the near future and the distant future.
Sure. So I want to just caveat my answer with saying that my opinion doesn't matter, because it depends on how you reflect that, obviously, in your positions while considering what happens if you're wrong. And I always say forecasting ends up being a fool's game. And then you also, like, this is where I also just wanted to point out like a self-awareness thing, is you also have to know, like, where's your strong suits and so forth, right? So you don't, a lot of people on Twitter and stuff think that because they made money on a meme coin, now they can talk about macro, now they're an expert in DeFi, right? That's a huge bias that is also self-fulfilling. Yeah. So I just want to point that out, just so that I give kind of like a caveat to this. And also, just as another bias, just before I give my opinion, is like, and what's really important is looking for opportunity when macro forecasts are terrible, whereas most people are waiting for some investor to say how things are really rosy, and then they invest, but that's when you lose money. So yeah, just starting with that. Now, with my view, having said that, my opinion on macro in regards to, the money kind of printing related issues, because we're kind of being relevant to Bitcoin and crypto, is that we have a world with issues that to solve would take decades. Because, even Dalio talks about the long-term debt cycle, all that kind of stuff. But the problem is those problems are trying to be solved by people with 4-year incentives. And by 4-year incentives, I'm obviously talking about presidents, prime ministers. And so no matter what, when a politician is facing the choice between their legacy and votes versus doing the hard thing for 20 years from now, and it's whether you're going to win or lose, and the option you have is if you print money to get over a hurdle and you're going to win, they're going to do it. And so even if you get a president that's like gung-ho and, serious, most government systems in the world still need a majority in, the lower upper house or legislature or whatever in each country. And so then even if the president is willing to suicide his term to fix something, you have other politicians in those houses that are looking from the view of what's good for their electorate today and what's good. And then they're going to focus on what's good now, right? They're not going to think about 20 years from now when they might not even have a job. So we've already seen those dominoes falling. And so, and seeing how things that people consider obvious, but every time you go back and look, the answer was money printing or some kind of come up with some other theory like modern monetary theory or something that justifies the kind of new way to do it, to justify it intellectually. And so, yeah, and then on a wider kind of a longer term view, like we're already seeing the dominoes fall in countries that we used to not even think about in relation to inflation historically, like, Argentina and Turkey now obviously in big trouble. And then, so those dominoes are falling from that type of printing money to fix problems and corruption in smaller countries. And originally we only thought about that in Zimbabwe and stuff like that, but now it's coming to countries that we travel to and understand and can culturally agree to. And then even longer term, then people say, well, the US dollar is still strong and stuff, and I agree, but the world debt is basically denominated in US dollars, right? So all the other countries are going to get screwed before the US dollar gets screwed, because if you consider USD to be a shit coin, it's still the best shit coin out of all the other shit coins. So, who knows how long it takes to play out, but
Right.
like Ray Dalio talks about, like history rhymes but doesn't exactly repeat, and the length of time on the grand scheme of history, whether it took 30 years or 70 years, is very different for each human being, because we might be dead, but yeah, it tends to repeat. And so who knows how long, but change happens slowly then all at once. So I think we'll be able to, like an example to that, I remember in 2010, I remember people, myself included, thought like the idea of electric cars, like just everyone thought electric cars were a stupid thing and that there's no way that would become modern because of battery power and stuff. And just 10 years later, we're on that adoption curve, and no one would have seen that. I mean, obviously, a majority of people wouldn't have seen that coming. So I think it's the same thing with this. No one's going to see it coming, and then everyone's going to see it coming. So that's kind of how I think about it.
Yeah, and I mean, I think once you start printing money, it's kind of a runaway train at that point. It's just when, when things are going to start falling apart. And so along the same lines, we talked about kind of the macro. How do you think Bitcoin and crypto as a space is going to fare in the future? And with the ETFs and institutional flow coming in, do you think there's the impact that's going to be had is going to be rapid or gradual? There's a lot of discussion on, this is the last run. This is the last run before people can actually make money. That, and then the second part of this question is, what is your take on CBDCs and how that might tie into what's going on economically?
Right. So, well, firstly, just from a wider lens, like countries and institutions are coming and have been for a while now. Like you have a small country like El Salvador that led the way. We now have a Bitcoin supporting president in Argentina. We've had support from, you know, smaller companies like MicroStrategy that then led to companies like Block and X to dabble into doing similar. And now you've got, BlackRock, Fidelity, you name it, with CEOs just years ago that were saying it was a pet rock, tulip bubble scam coming out and now saying it's a flight to safety, right? So that's another example of how change happens slowly and all at once. And by the way, the people that still refer to like the tulip bubble was like short-lived and died and never to return. But Bitcoin as an asset uniquely has declined top to bottom 75% multiple times. And no bubble that we've ever talked about in markets has ever done that. And then you have to ask, well, as we reach closer to $1 trillion market cap, you have to sit and think like, what asset has ever crossed the chasm into $1 trillion asset class and then just disappeared? So we're talking, and people are realizing that this is not just a bubble, and that there's something bigger at play, right? So, and then with ETFs, like not straight away, but over time, what I've mentioned before, like a passive bid from funds that are going to have a certain percentage of retirement mutual funds have direct exposure to Bitcoin without buying a proxy like MicroStrategy or CoinStock to get exposure. And if they allocate, say, 0.5% of that fund, that cash flow that comes into those funds, like because of retirement accounts or whatever, that sustained bid is unlike anything that we've seen before for Bitcoin. And then obviously you can even look at like the difference in gold from when the GLD ETF was launched, and the kind of price rise post that period. And Bitcoin's going to be starting from a lower base. So that's just something to think about. And then on the topic of CBDCs, obviously they'll happen, but if you're saying, are they going to be a bad impact or whatever, I don't think it impacts Bitcoin because CBDCs can make it quicker to transact across borders, but it's an increasingly more surveillance-based system that's centralized where they can control where, hey, here's a, using crypto terminology, here's a $5,000 airdrop, but you can only spend it on consumer goods or what have you. So it becomes more controlled and centralized than what cash is. And so it doesn't solve for the individual sovereignty. And so if anything, it heightens interest in Bitcoin across the world. And then in regards to like just crypto wider, like alts, like people kind of just tie alts and Bitcoin, everything together. But if you think about like 100 years ago, there was still gold as a store of value, and then there was the stock market, and gold still exists, but most of the companies that existed then are gone. And so that's how I look at alts. We get confused because of, and this is another bias, and the lesson like I told you about when I first started dabbling in stocks and just saw these 3 ticker things, like you think, oh, they all have 3 tickers, so they're all companies. So, oh, a company goes up, then all companies have to go up, like that type of mentality. And we get confused in crypto because alt BTC pairs, like you can say, oh, this alt across BTC is going up. But that type of cross pair is like comparing your local convenience store going up in price against the price of gold. Like it's so irrelevant in terms of longer term timeframes. And so, yes, we'll definitely see the tokenization of lots of things, but that doesn't mean that the protocols of today will necessarily capture that value. And a lot of protocols, if X is the value that the protocol can provide, but why is how much value that value capture goes to token holders, and that's also missing today in a lot of things. And so there's just, there's going to be a lot of washouts. And so it's kind of like these people that say, oh, NFTs are the future. Yeah, NFTs are the future, but that doesn't mean that your NFT of a tree has to do well in 100 years. Like,
Right.
how many
Your
art?
JPEG. Yeah,
Yeah,
it's not
like
necessarily.
NFTs it's a category. It's not your thing.
Right.
Like, it's like art. There's millions and millions of art. If you said 100 years ago, oh, in the future, the Mona Lisa is going to sell for billions of dollars and it's only worth $100 today or whatever it was, that doesn't mean you went out and made a painting and then you said, oh, artwork is the future. It's like, yeah, all your art is going to zero. So it's that kind of things you can learn from history. It's just absolute stupidity. And so, yeah, they'll say, oh, Kun, you're so dumb because I made, and they'll say this at the height of bull runs. Oh, I'm
Of
up on
course. Yeah.
my coins and I'm up millions. It's like, yeah, but then you lost it all. It's a
Yeah.
liquid, and then nothing you've learned from NFTs are you going to be able to apply to any other asset class. And so you're a one-trick pony. But now you're talking about, I find it embarrassing, the guys who are just in NFTs, but they're giving lectures on Bitcoin and the macro and investment process. It's like they don't even know. Yeah, it's just and that's why when you listen to advice, it doesn't matter the follow account. Actually apply what their advice is and just kind of like think about it in multiple different futures and outcomes and see if it's applicable as advice or if it's just hindsight, survivorship bias masked as genius.
100%. You touched so many great points there. And I think there's a lot of delusion of grandeur when it comes to this space,
Yeah.
especially with all the money that was made the last cycle and lost at the same time, right? And I
Well,
think it
by the
was really.
way,
Sure, go ahead.
oh, sorry, I'll let you continue, but I just want to say, and just for the newer people watching, people always repeat, oh, how much money people made last cycle. Like most don't make money; they end up round tripping and losing more, right?
Right.
Or they make it and they left it on FTX or whatever. So just to caveat that, it's like, yeah, I think people should just have a more healthier view of, oh, you can make millions. It's but what's important is the process of putting money in the market and then actually realizing that gain, which people don't do, right? So anyway, sorry, mate. Just wanted to.
No, no, 100%. You were actually coming to the point that I was about to make with making money and actually keeping it is two different
Right.
things. A lot of money was made and a lot of it was lost as well. And there's a lot of engagement on Twitter, engagement baiting on P&Ls, even with trading. People are photoshopping their P&Ls, throwing those up with crazy amounts of leverage. So anyone listening in, just be mindful of that. Don't get caught up in the $1,000 to I ran my account up from this wallet, ran their account up from $1,000 to $2 million in the course of a week, right? How
Yeah.
many of those have we seen? And the amount of engagement that they get is actually
By the way,
it's
I've seen those accounts
flabbergasting.
and I know that some of those accounts and those same accounts last cycle also ran it up from almost nothing to millions, but then they lost it all in the bear, and so they're starting from scratch. So,
Right.
like, is it impressive that over 3 cycles that you've made no money actually cashed out, but you've done 0 to 1 million 3 times? Like, it's
Yeah,
just not
exactly.
impressive to me. So yeah,
Exactly. You want to keep the money you make, right? And
and you
so
got to
anyone
compound
listen.
it.
Right, you
Yeah.
have to compound it. You have to compound it. So though, yeah, it is attractive. It is attractive to make life-changing money, but I think the goal here is to actually keep the money that you make. And so yeah, that was some great discussion that we had there, and we were talking about alts and kind of the macro environment. Where I want to shift our focus on is narratives. A lot of people that are going to be listening in are
Mhm.
probably curious to understand what your thought process is when you're formulating a thesis on a narrative, or how do you go about making that assessment or filtering
Yeah.
information when it comes to those.
And this is going to be controversial too because like which narratives is a dangerous place to begin, because in crypto we tend to call use cases narratives, because of this realization. Like people just view it as, oh, but in crypto it doesn't matter because the narrative's going up, and the way you make money is the way you lose money. And so all the same guys that are going to make a lot on narratives, on the running up to a million, they're the same guys that just lose it, and then they come back next cycle with some other thing. You can make a lot on speculative narratives, but as we mentioned earlier about like the importance of like understanding, like no entry price is low enough and no exit is too high, as there's no end to a framework. And so and in the end it goes to zero. So like I said, if it's down 50%, you don't know if it's cheap or expensive. If it goes up, at what point does it stop? So it's basically just a casino bet, and there are guys in the casino that are going to make more than the guys working at the casino. And so instead, I'd focus on use cases and look for things that can and already are going to be used, not because that's what's going to make you the most X, but those are the things that you can actually create a thesis and process around, so that instead of not making a theoretical 100x, where because you don't even know where the top is, you have to sell a bit at every 2x, and then you have to take 80% loss, and then overall you end up going to be up like 4x on like a 1% position, because you can't put a 5% net worth position or portfolio position into some random speculative alt. You're going to make a lot more money making a 10x or 15x on a sizable position. And so these are the kind of things that you've got to think about on that. So you want to be early to areas, or look at areas that are misunderstood, hated, and find the pockets within those that have high growth potential and product market fit. Like I said, not because hype is where we can't make money, but the execution is just not going to happen. Like you miss selling the 1 month it's up, because alts can top early, mid, or late cycle. They don't line up exactly with the Bitcoin top. So it could do most of its run in month 1, and you are up, you join like 30% of the way through, you then see it go up 10x, but then if it drops 70% from the top, you're down. And so the only way to play those type of speculative plays is to then just have like 30 different bags, but then you're never going to be able to exit properly either. And so, yeah, you really have to think about the reality of the execution up front, instead of just, oh, we're seeing AI narrative go up. And dude, the second people realize that some of these AI things are basically just a chat GPT plugin on the back end, it's like, oh, but I don't care because it's going to go up 50x. It's like, it could go up 50x, but by the time you found this pick and narrative, you didn't buy it at the peak or bottom. You bought in at about 5-7x because you think it's a low market cap, quote unquote, because of other market caps. But when the market turns, the same thing happens, where everything goes down. People actually realize that there's no users, and so yeah, I'm not telling you that you're not going to make a lot. It's just that the actual execution of it is not as the way that people think it's going to be. Because people think, oh, I'm just going to exit before the Bitcoin cycle top, and because Bitcoin is going to go to conservatively 100k, I'm really smart, so I'm going to just say that I'm going to sell this alt when Bitcoin gets to 70k. But if you look at alt charts, a lot of alts can peak 20% into the Bitcoin bull cycle, 40%, 60% in, 80% in, and they don't line up with the Bitcoin cycle top. And so like people are using false narratives to justify stupid decisions. And so you play stupid games and you win stupid prizes. So yeah.
Yeah, so that was a lot of information and great information added. There's a lot of different directions we can go with some of the stuff that you've mentioned, but I also wanted to get your take on people who shitcoin, right? Micro caps. A lot of people come in with $1,000, $2,000, and are looking to make it big. Playing micro
Right.
caps or also following the one. This is also a controversial subject as well. Is in this space, you have a few of these accounts that have been around for a little bit with a lot of followers, and they can make a tweet and move alts, let alone microcaps. There's
Yeah.
folks that tweet microcaps, and obviously KOLs and that environment. It's highly toxic environment, right?
Yeah.
You have KOLs taking tokens, basically tweeting out certain microcaps and then dumping on the people, basically getting exit liquidity from their tweets.
Mhm.
So what's your thought process on that entire environment? Do you think it's going to survive past this cycle, or do you have any take on
Right.
that at all?
Yeah. So one thing is, there's nothing wrong with any strategy in itself, but you just have to know what you're actually doing. So that strategy of buying into 200K or 400K market cap and then selling at 2 million, 5 million, whatever, is not an investing strategy. It's a liquidity pump strategy. It's no one knows it. The project is shit, but just awareness is going to bring in money, the liquidity pumps, and then I'm going to sell. But because people mix, they don't have any process. This is what they do. They put in money at 400K, it goes to 3 million, and then they think it went up because of fundamentals. And then the influencers start, but they're like, oh, this is actually a quality FA project and it's going to go to 20 million. It's going to go to, it's just like, just this bias, just like self-confirmation bias as price goes up, that fundamentals are getting better and stuff. So there's no one strategy that's wrong. Like, full respect to you. If you are a meme coin specialist and you've figured out that, okay, from every 50 launches, that any token that goes above 5 million market cap tends to do at least a 2-3x. And so I'm going to focus on that. And then I've got this process in place. Then kudos to you. I've got nothing bad to say to that person, because they understand the dynamic of that market, how to play that market, right? But you just got to really understand what the game is. And so that's, but yeah, in your point of influencers, any influencer that self-congratulates themselves for bringing awareness to 400K market cap, so I brought you this at 300 market cap and now it's 5 or now it's 10. They're not investors. They should just say, look, I'm an expert at creating liquidity pumps. So if you want to follow me, follow me within the first X of when I say put in money at this price, you'll make some money, but then sell X. That's a much more accurate and self-aware point of view to do it. But people lack that self-awareness. And then the second point, and by the way, there's no right or wrong. Like if you're playing with small money, that might be the right strategy, because you could go split $200 on 5 things and a liquidity pump gets you like 10, 15 grand, and then you can do airdrops and stuff. So I'm not saying any one strategy is wrong, but the problem is that no one has a process. And then the second thing is, will this exist? It's always going to exist unless regulation stops people actually launching contracts on DeFi, which I don't know if it's even possible, because the way you think about it is it's always going to exist. It just gets harder. Like hedge funds in the 50s, all the hedge funds that started made a lot of money because there was no competition. If you started a hedge fund, someone was willing to give you money. Hedge funds still exist today, and there's still speculators today, but the results become, lower, right? And so the reason people think, like some people get confused about that, is they think there's not going to be any shitcoiner in the future, but that's because in stock markets you can't trade penny stocks next to the S&P 500, but in crypto, side by side you can trade Bitcoin next to Donkey X, Dildo Coin, and so those coins will keep launching. But if you look at the charts now, there were more sustained pumps on just crap, kind of like you imagine the 2000 tech bubble, where the pumps lasted a year. So it provided a lot of time for people to come to the realization that, oh, this is frothy, like maybe I should sell. And so there were maybe 20, 30% of people that sold and made a lot of money.
those pumps are still going to exist. They just happen shorter and shorter. And so people look at a chart and say, well, this still did 30x. Yeah, but like it went up and down 30x within a 2-month period. And so the number of survivors and people that make money of it is just going to reduce over time, because as the liquidity increases, there's also 100 times more projects to speculate on. And so that money just won't find its way to everything. And so instead, it will quickly rotate from one to the other, creating faster pumps, but also much faster drops. So that's what people are missing in that kind of history rhymes type scenario.
Yeah, so I agree with you 100%. All the respect to people who, play shitcoins and have a process in place, because I mean, at the end of the day, there's a lot of inefficiencies that can be taken advantage of in this space.
Yeah.
And I personally know a lot of people who have it down to a science. So I think all kudos to all those people.
By the way, the problem is the followers of those accounts and some of those people that do make money don't.
Yeah.
They then move beyond their wheelhouse, and then that's when they screw up their
That's the
followers.
problem. Yeah, it's the delusion that it becomes a problem, right? I mean, yeah, it's like when you come out and say you're an expert in other fields that you're you shouldn't really be.
Or not even that. It's like, oh, I called this shitcoin at 500K to 5 million. This layer one that's like $1 billion market cap is going to go to 100 billion. It's like it's not even the same game. It's not, you're not going from being a good forecaster to good forecaster. You're playing liquidity pump awareness into mass wide market speculative bubble type frameworks, which is not the same.
100%. And I don't think that's going away anytime soon, that that entire so I think it's just for anyone listening in, just be aware of that and understand where you're getting your information from and what you're reading, and where it's coming.
Have a process, and how are you going to start exit? And if there is no pricing framework that can come to an effective valuation, that's good for the upside, but it's also just as bad for the downside. So how are you going to mitigate that? How are you going to know if the alt tops early, mid, late cycle, if it drops 40%, are you selling? Are you holding because you think, it has more legs? But you can't justify that and say it's cheap or mispriced, because it's not cheap or mispriced. It's a speculative bubble play. So you have to use the right framework and process for the methodology and play that you're looking at. But people just mix it all up and end up being a little bit of everything, which ends up being the little bit of everything is kind of like, if you focused and just played soccer, you could be a pro soccer player. But if you're the kid in high school that could play a bit of soccer, could play a bit of basketball, could do a little bit of this, later you're going to be teaching sports, which there's nothing wrong with being a sports teacher, and not a dig at that as a profession, but like for someone that wanted to be a pro at a sport, trying to be good at a bit of everything is going to guarantee you that you're not going to be good at the one thing that makes you the lot of money from an investing standpoint. So
100%. And so before we pivot, and we're kind of coming up on the last section of this conversation, I wanted to ask if you had a take on perps being offered on dexes. And that's kind of been a use case that's at the forefront currently. Do you have a take on that? Do you see any lapses there, any issues when it comes to dexes that are offering perps trading?
do you mean from a regulatory standpoint, or?
Yeah, it could be from a regulatory standpoint, or from the standpoint of an investor or trader, or anything that you might see, if there's any lapses that you see currently, or any issues that might be coming in the future.
Yeah, I mean, you've always got to consider like regulatory, but that's anything crypto. But the one plug I will give for DeFi, because, and I'm only doing this because I know no one likes DeFi right now, so I know that my opinion's not going to cause any type of speculative bullshit. But in DeFi, there is a lot of areas where DeFi is actually required in one way or the other. And so Like, dude, these guys in Argentina who actually need stable coins to save, everyone's arguing, is it Solana's better, ETH's better? These bros are putting their money on Tron because they need to have interoperability with other people. Like, I can't have money on Solana and you have money on whatever, and then we transact and stuff like that. And so coming back to DeFi and perps, the good thing about these type of things, at least, is they're not the highest X's, but if you can come to understand usage growth and patterns over time, it's easier to come to valuations that TradFi will come to valuations on. And so if you're early, you're not able to make necessarily the doggy Mimu 1000x, but you can still make a lot of money and then still easily find ways to have invalidation thesis and validation thesis and track your thesis. And if you're early, you're able to beat TradFi to that game. And then as far as perps and stuff goes, like, I think it's at the moment a big issue is the fragmented liquidity, so that if the big player wants to play perps on a DEX or something, they may need tens of millions of dollars to be able to exit and enter into quickly. And so you want to be able to see, okay, how and why and how a protocol is going to create larger pools of liquidity. How are they going to increase the ability to onboard onto these protocols that don't rely necessarily on centralized exchanges? I mean, there's a lot of stuff like that, but what do I think about it? It's just really, you have to think about all these things.
Yeah, 100%. I think you mentioned some great points. So there's obviously the Lumen regulations is going to be there, and then liquidity and all that stuff. So we've covered, everything investment related. So your kind of philosophy, macro take, and everything. So I want to get to know you a little bit better. So a couple of questions I had for you. First one, do you have any interesting stories that you might want to share over the course of your journey in crypto or investing in general that you think might be insightful for anyone listening in? It could be anything that was of inspiration to you. It could be a funny story, anything, any kind of anecdote that you can share.
I can't think of anything like super interesting. And I mean, I've talked a lot about how I got into it and how the consequences of events kind of stumbled upon, crypto and stuff. I'm just going to share something that's extremely basic, and not because it's a good story, but because this is really the reality of what investing is like. But it's really just mainly boring. Like, people think I'd be like jumping up and down, making a lot or something, but 99% of the time you're really just sitting in positions,
right?
And only 1% of the time you're actually doing any selling or buying. And so many people talk about how important to research and this and that, but for the people that are buying and selling something every day, researching, you really have a job. Like, you're not really investing in the pure terminology of it. You're really a self-employed, and you pay yourself a paycheck, and your hours worked translate to a maximum amount that you can possibly make, because you're not allowing yourself to come to exponential outcomes, only step up. And so I mean, that's not even a story, but I just wanted to give you something so mundane and boring, because I just wanted people to realize that it should be mundane. It shouldn't be like, I went all in on Luna and I just got out and I jumped on, like, I do have stories like that where, like, you have money on, you had some money on FTX and you got out before, or you might have put it in and then the exchange shut down. But like, it's nothing that people can really learn from, apart from the fact that, like, you should have a process where you're never putting all your money on any one thing. And on a process basis, it's not just about the picks, but how you segregate where you put the money, how it sits, all that kind of stuff. So you've got to think about that. But yeah.
Yeah, 100%. I mean, you bring up a great point. It should be mundane. If you're jumping up and down on a daily basis, you're probably not really investing. You're probably gambling.
Yeah.
And so I want to go into this a little bit more. Investing is a pretty mundane activity. What do you like? What is your typical routine like, and what are your hobbies outside of, obviously setting people straight on Twitter? What do you do outside of that?
But
I see you
I feel
spanking
bad for that.
people.
I don't. By the way, I
Honestly,
don't. I know some people think like I'm just trying to hate, but it's people just have to understand where that comes from, and it's coming from the viewpoint of I've seen exactly of people like suiciding, losing all their life savings following that, and so it doesn't come from the perspective of I hate you or whatever. It's just I just want to give the opposite but critical viewpoint. So it's not hating on that person, but like holding them accountable, because I will shit on my own positions, like, and take the opposite view when I see a view that's like, you'll see this, I'm long ETH, but I shit on people just saying like, talking about in some way, not because I don't think ETH can do well. It's just because I want people to see both views so they don't put themselves into the perspective where they think that, just going 100% ETH is then going to outperform, Bitcoin, and then they can just hold it for 20 years and all this kind of stuff. And so that's where that comes from. It's just to introduce a critical viewpoint, not to just hate. So I won't reply on a lot of stupid stuff if I don't think if it's not going to be detrimental to the people that listen to the advice or follow, because it's just funny. But yeah, when I think it's dangerous, that's when I'll make a comment. So yeah, just to
preface it too. I mean, if anyone sees your responses, they're logical. You're not saying stuff that's inflammatory in a sense where it's just complete nonsense. You have a logical discourse, and so I think it's coming from a very genuine place.
Yeah, so it's not. Yeah, exactly. So it's just to balance out the view. It's not that's my number one view on the topic. By the way, right? Because
exactly.
I can both be long and then still shit on it. So because I'm trying to tell them the invalidation points and stuff. So but yeah, as far as what my day looks like, I think if you're like stoic and you have this kind of mentality, and I say you can't separate the person that you are from the investor that you are. So you can't be an erratic person in real life, but then be a very good investor. So you have to embody the mindset as an investor in your real life too. And so as you can imagine, my day-to-day would be just like that. I'm not helicopter jumping, skiing. I'll wake up and I'll do some reading. I'll go to a cafe for lunch. I'll check on Discord. I'll go for a walk. I'll just do some more reading. I'll have dinner. And then relax, and then maybe watch a movie at night, and then go to sleep. So I basically do what I would do. I basically do what I want every day. And this comes to like, that's kind of even what Buffett talks about. Like he just reads all day and like he just enjoys it. And that's why I say when you find people on Twitter, find people that are kind of like you, or so that, because the stuff they say will resonate with your temperament and psychology, right? And my day-to-day is, DJ and Spartan talked about this, but you really then apply the same investing principles into your life, and just optimize your life the way that you would your framework. Like, what are you investing for? Are you investing to make money calmly, or are you here to get stressed? And then you realize, oh, well, I'm actually here to make money and to live a calmer life. Then you shouldn't be day trading, or you shouldn't be speculating on a daily basis, like going from anxiety to loss. And so same within your real life, like how close do you want to be to amenities that so that you don't have to travel and have daily commutes? And like, do you want to just have one outfit that you wear so you don't have to think about what outfit you're going to wear? Is it important to have a very comfy bed? Like, and so all that kind of stuff is reinforcing. You find peace in your life, then you find peace in your mindset. It helps you with your investing. It's all kind of a big self-fulfilling cycle, in my opinion. By the way,
no, 100% agreed. I talk about this a lot too. Is purpose and intention. A lot of people, start trading. I mean, I want to make a lot of money. Everyone wants to make money, right? But what's the actual intention behind it? What's your actual purpose behind it? I don't want to get too philosophical here, but I think it's good to have purpose and intention behind, everything that you do, whether it's your daily routine or the reason why you're investing, the reason why you're trading. So I think you touched upon that perfectly. One question I like to ask, and this is mostly also trading related, but I think it works for investing as well, but not specifically investing, but just your general psychology and mindset is how do you take breaks, or how do you reset yourself when you're stressed out? How do you manage stress in general?
So my highs and lows are very close together. I don't really get stressed anymore, like in terms of that kind of extreme stress. Like if you looked at my facial expression from if my net worth was up 30% or down 30%, you couldn't tell. But that comes from like what I talked about, like the general way that you set up your life. So set up your life in a way that minimizes that stress, anxiety. If you're running around, you're always got 100 things on the day, and then you have to, check things. You're just causing stress and anxiety, and it just becomes that circle. So you have to take that stress away from your life just as much as you do out of your investment process. But I do recognize, and this is another thing I learned from DJ and Spartan, is every once in a while he's here every day, and then for 2 months at a time he'll just disappear. And that's what I do. Like I was here for a while, and then for 2-3 months I just went overseas. And so I'll just be here, and then I'll be off for 2 months because I don't need to do much anyway. You're just here kind of for potential inflection points, or where you think things might be dangerous or whatever it is. But yeah, you don't need to be here all the time. So extended breaks, things that help you break patterns, because a big problem with people investing is people expect to log on to Twitter every day for 2 years, 3 years, for thousands of days, and a habit takes only 30 days to form. And all they've done every day is buy without much selling, and then they think they're just going to wake up one day, sell the top, and then just not put that money back in, not get swayed by their friends and stuff on Twitter. Like that's just not going to happen. And so people are like, oh, why do you just take a 2-month break? It's like I can't explain every single thing that I have applied to my strength and weakness framework, process framework, but that's like another thing where being able to take cold turkey 2-month breaks, it just it helps you build break frame things into your process and thinking that allows you to move against the grain when it's needed, when everyone else and even your gut might be telling you not to do it. So get rid of all the clutter, minimize the stress in your real life so that you don't have stress in your investing life. And then
no, 100%. Those are some great points. I mean, it's difficult. A lot of people in this space are so entrenched in it day in and day out that they just become part of. They don't understand there's a world outside of, crypto Twitter, and they don't understand how much of a niche they're in, and in the way they're thinking and following, all these people that they're, whoever's tweet they're reading day in and day out.
Well, so and that comes back to bias again, because those guys that are just on CT, it's not even that they shouldn't be there, but without the self-awareness that the longer they're here, the more that they actually become the average consensus, average outcome that's going to lose money. But they don't see it that way. They just think that they're there and they're gaining alpha only.
Right.
But the more time you spend, the more you are creating the biases in place for you to become the exit liquidity, which is the ironic part of it.
Right. 100%. And yeah, there's nothing wrong with using. I have been
Yeah.
actually fairly active the past 5 or 6 months,
Yeah.
but I understand why I'm on there, and I understand what I'm looking for, and I understand what's going on. You know, so
Exactly.
having that understanding in place and that framework is
Exactly.
beneficial. So just wanted to come to this last part of this conversation and ask you, you know, if there's any advice that you want to give to anyone listening in that might be embarking on their journey into financial speculation right now, or this might be their second cycle.
Yeah.
What are some points that you
So
might
number
want to mention?
one, yeah, you got to consider if you're wrong, at least put yourself in a position where if you don't make a lot of money and you end up fully round tripping, because it's highly probable that it happens, even if you think you can emotionally manage, at least be in a position where even if Bitcoin declines 70, 80% from the top or whatever it happens to be, that your entries potentially were early enough that the wrong outcome doesn't lead to complete wipeout, because that's important. At least get a chance to play again. And then the second thing is, you know, we tend to all have the view that all these bad stories, like, oh, it won't be me. You know, I can't understand why someone would do something, and I don't know, you know, how someone can round trip so much money. If that was me, I would have cashed out. Like, how does someone make round trip millions or deca millions or hundreds of millions, and they think, how's that even possible? I'll just give you a snippet as to how that's possible, even if you think that's not possible. It's and this is what happens if you don't have a process, right? Like, let's say you reach some random milestone number and, you know, you're like, holy shit, I've never imagined having this much money. And then you're scrolling through Twitter and all these smart people are saying, oh, it can still 4x, Bitcoin hasn't even reached, you know, X $1,000. So then you're like, okay, I'm not going to be greedy. Even though I've got all this money and I'm not going to cash out, I'm just going to ride it for another 2-3x because these guys are saying it's going to 10x. And then instead of just retiring, you think about things like, oh, I'm just going to make another few x because then I can retire my family. But then even if you can retire your family, you start thinking, I'm going to retire my bloodline and generations to come. And there's just no end to that type of
It's never ending.
greed. And it's masked in the aura of helping others, because the intent to want to help your family, to help relatives and friends comes from, you know, it's a good thought, but it's dangerous because you don't realize that it's actually fueled by greed. And so you don't even classify it as greed, you classify it as you being conservative. And that's what's so dangerous about it. And so the exact mistakes that you make are the mistakes that you think you won't make. So instead of thinking, I'm not going to make that mistake, try to understand why that mistake was made, and then get yourself to a position where it scares you because you realize that you could have done the same thing. And you can do this for real life. Like, people say, I can't imagine why, you know, someone would become a murderer or whatever. Like, you have to be able to, I can't remember who talks about this, but you have to be able to put yourself into the psychological position of freaking yourself out as to how realistic it is that you could do something. And then it's only in that you can create and understand yourself enough so that you won't do it. So yeah, so to those people that think that they're not going to, for this example, so instead of thinking, oh, you're not going to round trip, instead you should be thinking, okay, oh shit, oh, that could be me. So how do I have a multi-factor strategy to sell, and not just put that money back into the market that considers multiple factors? You know, so okay, how do I do that? So I have equal size bets. How, you know, make sure I have a chunk in BTC. You know, oh, maybe I'm still going to FOMO. I don't know how to protect against that. Okay, maybe I sell half the gains into Bitcoin so that if Bitcoin still goes up to some crazy level, I'm still exposed to the market. But if Bitcoin drops, it drops less than alt. So at least I've made more Bitcoin, you know. So you're just thinking through all these things. So yeah, think through the scenarios.
Yeah, you dropped some gems there. I mean, being able to have a Bayesian framework and think through what can go wrong, not just what can go right, is I think
Yeah.
is huge and extremely important. So one last thing I wanted to ask you before we wrap this up. Do you have any Twitter account recommendations? Are there any small account gems, and also any book recommendations? Any books that you'd like to recommend for anyone listening in?
Yeah. There's a lot, and so I don't want to be in a position where I forget to plug. But I will give you the answer from my view of, when I say like you should follow people that are similar to you but further ahead in the journey type thing. And so as an example of what that looked like for me, so then other people shouldn't just go follow the same people, but then go find the same people that they can relate to. So yeah, like, for me, I mean, DJ Spartan's not even a small account, but helped me a lot with solidifying views that I had with large money. Bob Lucas is great with psychology. You have, if you're wanting to focus on the peacefulness of life and wider markets, then, people like yourself and Rec Diomedes does a great job kind of curating the not just investment requirements, but the kind of wider psychological, thing frameworks. You and I are both a fan of, Crypto Lynn. She just has a very additive, positive mindset. You can learn a lot without dealing with the my bag is better than yours and stuff like that. So you can actually just think through things. There's a lot of, there's an endless amount of, good accounts, depending on like what type of things that you're looking for. I've plugged previously that Lynn Alden is a good example of just thesis construction, and having ways to manage long-term thesis. And so, yeah, there's a lot, but yeah, those are just some that I like.
No, I'm humbled that you mentioned me. And for anyone listening in, I mean, they probably know you already, but if you're not following him, you definitely should, because he, just from this conversation, you can see how insightful Kuhn is, and he drops his tweets are amazing, phenomenal. And is there anything else you want to plug, Kuhn, besides your Twitter account?
No, I've got, that's what I also, I don't have anything to plug. Like when I'm like, I came here to literally pass the time from Better Bull, because there's only so many cafes and walking around I could do. So I thought like, oh, at least I could fill some time with sharing some things that I've learned. Yeah, so there's nothing. I never even thought I'd even get like 500 followers. I just thought I'd literally pass the time. But then, yeah, I'm grateful that more not for the followers, so to speak, but just the validation that like it resonates with people. And I know I've got followers that and people that I talk to that are worth tens, hundreds of millions. And so, I'm humbled that it's useful, and that it's been something that I've been able to use to revalidate some of the viewpoints I've had, change some of the viewpoints I've had, and then also kind of, and I've wanted to help people the way that, like, I imagine like, oh, if I just had these kind of viewpoints when I started, maybe I would have learned this faster or that faster. So if just like one or two people don't lose their life savings, or they learn a process which ends up giving them a framework, then then I think that was worth it. So yeah.
Yeah, that's awesome. I mean, I have just gotten active on Twitter the past 5-6 months. And that's solely the reason is I just want to share my experiences, and even if I can help out one person, I think for me that's an accomplishment. So that's great, Kuhn, and I appreciate your time. I was really looking forward to this conversation, and I really appreciate that you took the time to sit down with me and have this conversation.
Mate, I'm really glad we got to chat, and it was an absolute pleasure. So, and again, thanks for invite.
I greatly appreciate that. And before we end, I usually like to end these with like a quote from a Stoic or some quote that I like. And what I want to share today is there's a quote by Epictetus: "Don't explain your philosophy, embody it." And Marcus Aurelius has something along the same lines: "Waste no more time arguing what a good man should be one." So, these discussions are great. You're listening in, you're reading books, you're listening to these type of discussions. That's only one part of the puzzle. What's important is you go out and get messy, and get into the mud, learn, and see the full benefits of these frameworks. You need to embody them and actually practice them. So there's a lot of talking the talk, but make sure you're walking the walk. And for everyone listening in, thank you for tuning in. Hope this conversation was as enjoyable for you as it was for me to have with Kuhn. Until next time, thank you.